Hello and welcome. My name is Kathleen Lovito, and I'll be your host for today's webinar on the 2021 Mid-Year Market Update with Gary Aiken, Senior Portfolio Manager at AAFMAA Wealth Management and Trust. Before we begin, here's a little bit of background on our association. Our mission is to be the premier provider of financial planning and investment management and trust services to the American Armed Forces community. We are a fully owned subsidiary of AAFMAA. AAFMAA has proudly served America's armed forces since 1879. AAFMAA is a nonprofit tax-exempt 501c23 member-owned mutual aid association offering life insurance, wealth management, and mortgage services to all branches of the U.S. Armed Forces and their families. This presentation is educational. It is for general information only and is not specific investment, legal, or tax advice for any of you individually. Do not rely on this presentation alone to guide your investment management decisions. Since each situation is unique, your needs for financial services will differ. For individual advice, please contact us directly. Now, without further ado, I'll turn it over to Gary to begin.
Thank you, and welcome to all the members listening today. I'm Gary Aiken. I've been with AAFMAA for over 20 years in a variety of roles. Today, I'm Vice President, Senior Portfolio Manager, and Risk Strategist for AAFMAA Wealth Management and Trust. I want to walk you through a very short history of the last 18 months, do a deep dive into inflation, and talk about markets this year and our views going forward. With the pandemic medically behind us, I think we can look back and make an assessment. We emerged in early 2020 to witness the impeachment of a US president, and as soon as that was over, the press started covering this strange disease from Wuhan, China, that was spreading to Europe, and in hindsight, had probably been in the US for a while. We at AAFMAA Wealth Management and Trust first read about it in December and early January. We drew up some whiteboard ideas about what it might look like, and with the scary numbers coming out of China, that included the potential for a 3 to 5% mortality rate. The markets freaked out. We saw the 30-year Treasury drop below 1%. We saw stock markets decline further, faster than ever before. As Art Lyons, our CIO, pointed out, we were prepared. We had modeled the potential for lockdowns and what that would mean for the US economy. When markets reacted the way they did, it seemed both rational and panicked at the same time. But the US government and the Federal Reserve acted with speed and ferocity too. We took that quickly as a sign to buy stocks, to sell treasury bonds, and to buy corporate bonds. We were risk on in our portfolios. As the boom economy of 2019 turned into the Zoom economy of 2020, we were prepared and made decisions that gave our clients something to be happy with financially, despite the doom and gloom around us. But from our perspective, it seemed rational to act the way we did as people, as society, as corporations, as government, and frankly, as markets. The response to that incredible downturn is a recovery the likes of which we've never witnessed. And along with it is something we haven't witnessed for almost 40 years, high inflation. That's on everyone's mind, so let's talk about it. By the way, the second picture features my Honda Accord waiting in line patiently for gas. I didn't have my bell-bottom jeans on though. That was before my time. The Fed says that inflation is transitory. What does that mean? Well, the dictionary says transitory means of brief duration, tending to pass away, not persistent. I think what a lot of people get wrong in thinking about the transitory debate is the believers in the transitory inflation story, and that includes us here at AAFMAA Wealth Management and Trust, don't argue that the increase in prices will be offset by decreases in prices later. No, we believe that the high rate of inflation, 4 to 6% that we're experiencing over the past few months and probably the next few months won't persist forever, and that will return to the 2 to 3% inflation rate that we've had for the past 30 years or so. A lot of people making the other argument will say, yes, but we're printing so much money. And that's true. The black line on the chart represents the amount of money that has been printed, and it's up to $22 trillion. You can see that sharp increase at the right side, and that's the Fed printing money like there's no tomorrow to finance federal government deficits to fight the pandemic. But the blue line is the rate at which that money circulates in the system, in the real economy. And you can see that that number has been going down for a long time. I think a lot of people like to quote Milton Friedman, the famous economist. Inflation is always and everywhere a monetary phenomenon. If you left the quote there, you might be willing and able to make the case that just printing money creates inflation. But you've only captured half of his sentiment, which is that inflation can be produced only by a more rapid increase in the quantity of money than in output. Inflation in prices is ultimately a function of supply and demand. The increase in the supply of dollars versus the increase in the quantity of things that those dollars are meant to buy. I like Samuelson, another economist's phrasing. You can lead a horse to water, but you can't make him drink. You can throw $1 million at me, but that's not going to make me, all else equal, buy more hamburgers or cars. Once I have enough of those, I'm going to put the rest of my money into more productive things, like stocks and bonds. And using money to buy stocks and bonds has not translated into goods and services inflation above 3% for the past 30 years. And in our view, is unlikely to contribute to an inflation rate above 3% for any long period of time into the distant future. That's a whole lot of economics mumbo jumbo. So why hasn't the inflation rate been higher? Our answer is technology. Technology makes products and services better, faster, and cheaper. If you can provide more at a higher quality for a lower or equal price, that's not inflationary, that's deflationary. Technology has kept prices from going up dramatically as we substitute, whether it's consumer technology, energy production, electricity efficiency, or computing power. We have more than enough computing power, and our ability to do more is growing exponentially still. Fracking led to a revolution, flattening the cost curves for oil and natural gas extraction. Developments in healthcare science have enabled us to map the human genome, and that sequencing ability gave Moderna the ability to map the coronavirus structure and come up with a blueprint for the vaccine in 40 days. And they said, with what they've learned, the next time it could be as few as 30 days. Think about how efficient a new house is today with better appliances, windows, and insulation. Larger houses today use far less energy. Technology is even changing money. We at AFMA Wealth Management and Trust compete with robo-advisors and zero-cost brokerage apps like Robinhood for your attention. We hope that our services are enough to continue to ask you for your trust, but it's something we're very mindful of every day, who we serve and how we can provide value for those services. And of course, our business has really changed. I don't think the frozen OJ market would have survived if we had to be in the pits trading during this pandemic. But instead, we were able to do all of those things using technology in our homes. We never missed a beat, and that has to be worth something. So where do we find inflation? In areas where the government subsidized prices, like education and healthcare. But technological disruption will come for those as well. There will likely be a huge change in the way we practice medicine, given the rapid adoption of telehealth. There will likely be a change to education, given what we all had to experience learning from home. Are we getting value for those dollars? Someone will come up with a better way. We want to identify those companies that are coming up with those better ways and put their stocks into your portfolios. To sum up, here's the way I like to think about inflation. What has gone up in price? Is it supply constrained? Remember our economists. And is that supply constraint permanent? If it is, then there's pricing power and inflation. For the most part, we think technology will continue to advance and that the high rates of inflation we've seen recently are likely to subside. Let me give you an example that everyone has been talking about. Here's the price of lumber. And as my chart says, lumber, more like timber. This is a fantastic example of an industry reacting to COVID-19 like it was the end of the world, and then realizing they'd made the exact wrong call and a total inability to catch up. The orange line is industrial wood production. You can see the sharp drop off when our country went into lockdown in March of last year. But as we know, people didn't stop building houses and decks and doing renovation projects. They took advantage of the fact that we were at home to do more. We had increasing demand against diminishing supply, and lo and behold, prices went up. They went way up. But as you can see, production has returned to pre-pandemic levels, and the blue line, prices of lumber, has taken a steep drop. And from the end of this chart, in middle of June to today, it's dropped another almost $174 to $700 per thousand feet of wood. Copper is another commodity that has gone up substantially. The chart on the left shows copper reserves versus copper production. There's tons of copper, and miners like Freeport-McMoRan have gotten extremely good at getting to it. While prices went up because of supply chain and mine disruptions, those are short term. Over the longer term, the price of copper has gone up less than CPI, almost a full percentage point below the rate of inflation. Oil prices are a similar story. Again, gross supply and production on the left and real prices on the right. Since the end of the Cold War, oil prices have had a lot of volatility, but in real terms, haven't gone anywhere. What about agricultural commodities? I switched this up with real prices falling over the long term on the left and a terrific chart that shows just how important technology has been to agricultural production since 1270 in the United Kingdom. Great data. Not sure why Henry VII and Henry VIII didn't keep better records, but safe to say that production didn't do much until the Enlightenment, and then a little bit more movement in the industrial production. But once you had tractors running on oil, boom. I heard an interview the other day that suggested there's coming financing revolution in agriculture that may put further pressure on prices and increase food security at the same time. So what's the story with faster inflation today? We have shortages, limited production capacity, trade disruption, extended times to market, labor non-productivity, and global labor disruption. Everything we buy and do has been affected by the pandemic, but that won't last forever. So in our opinion, we get back to technology driving innovation and its disinflationary force. Inflation, in our opinion, is transitory, but does that matter? Yes and no. What we're focused on here is what the Federal Reserve's next steps are likely to be. The Fed is focused on its mandate, including full employment. And this chart shows the number of months that it has taken in past recessions to recover all the jobs we've lost. The Volcker-Reagan recession, the Gulf War recession, and even the dot-com bust all had pretty fast job recoveries. The Great Recession led to a long, shallow recovery, and that's why it felt to so many like a jobless recovery. We are at the point where the pace of the post-pandemic job recovery has slowed dramatically. And whether it's because of business formation required to start new businesses to replace the closed businesses, or overly generous unemployment benefits, the Fed needs that employment number to move up faster before they're going to stop buying government bonds through quantitative easing or raise the federal funds interest rate. So from a top-down perspective, like everyone else, we're all eyes on the economic data and the Fed's response to that data. I want to shift to markets now. We live in a global market for money and investments. In the first quarter of this year, US interest rates went up much faster than the interest rates in the rest of the world. The blue line is the difference between the US 10-year interest rate and the German 10-year interest rate. Almost in tandem, the dollar, shown in red, got stronger versus global currencies. And as the transitory inflation story picked up steam in the US, interest rates fell, and the dollar with it through most of the second quarter. But starting in the second half of June, we saw dollar strength again as the Delta variant became a story. However, that didn't result in US interest rates going up. As a result, we believe that US interest rates will continue their upward trajectory in the second half of the year, reflecting a growing and stronger US economy. Continuing with my theme, a tale of two quarters, certainly not the best of times or the worst of times, but of times that were different. In the first half of the year, value outperformed growth. Banks and energy, especially oil, outperformed. We added positions like Goldman Sachs, Citigroup, and Pioneer Resources to our portfolios, but remained pretty heavy towards information technology and growth in our portfolios. That patience was rewarded in the second half of this year as growth really picked up the slack. We expect outperformance of growth to continue into the second half of this year. So far this year, small company stocks, as represented by the Russell 2000 index, have outperformed large cap stocks, as represented by the Russell 1000 index. However, large cap stocks have gained ground in the second quarter. Also, it's worth remembering that the Russell 2000 performance has been buoyed by meme stocks that find a home there, like GameStop, which graduated to the Russell 1000 on June 28th, and AMC Entertainment, which is the largest single stock in the small cap index. Large company stocks have gone up on increased revenue growth prospects and increased profitability. We're excited still about the prospects for large company stocks. And of course, the more things change, the more they stay the same. The US economy continues to be the best place in the world to do business, the best place in the world to raise capital, the best place in the world to invest. You can see this in the chart previously where the dollar got stronger. The US markets will continue to attract the best entrepreneurs, and as long as we continue to uphold property rights, the rule of law, and strong investor protections, which we believe are still in place, then we can expect general outperformance of the US markets. I want to say one other thing, which is that companies in the S&P 500 derive over half of their revenue from overseas. It's not that by investing in US companies that you don't get exposure to foreign opportunities. It's more that you get the best management, the most transparent markets, and the best investor protections by buying the stocks of US companies. For my last chart, I'm going to break with my theme and give you a much longer chart. I want to acknowledge that the compensation investors receive today for taking on the risk of investment grade and high yield bonds is the smallest that they've ever been. That is, regardless of the rate of the underlying treasury, corporate bonds are very expensive right now. Can they get more expensive? Yes. Is it likely? No. That is why we've had a two-pronged approach. First, we are encouraging new money to consider a slightly more aggressive portfolio in terms of an allocation that includes more stocks and less bonds. Second, we have shifted considerably the makeup of our client bond portfolios. We've introduced more variable rate bonds. Their coupons will rise as interest rates rise, and their prices should be less affected. We've also shortened the overall duration of the bond portfolio. We expect interest rates to rise, and so we want to protect our members' fixed income portfolios. Finally, fixed income is still an important part of a portfolio. The opportunity that we took advantage of in early 2020 was to sell treasuries and buy those things that were spiking wildly. Our members' portfolios benefited greatly and outperformed their fixed income benchmarks as a result of those actions. Bonds still provide a volatility hedge and a safe haven asset when there is turmoil in other parts of the financial markets. So let's summarize our views, which I've given some rationale for today, and whether it's our view on inflation, interest rates, or parts of the global stock market. We favor US stocks over international stocks. We favor growth over value. We favor large cap over small cap. In bonds, we want to get stronger in the face of tight spreads. In high yield, we want first lien security. And wherever we can, we are reducing interest rate risk. And as I've said before, we favor stocks over bonds and are overweight stocks in all of our allocation models. Finally, I think it's crucial that you take advantage of our complimentary portfolio review. This is a free look, whether you're a member or not yet a member. We have incredible tools at our disposal, which Ross Cutler and his team have curated. Our team of certified financial planners and investment professionals are excited to take a look at what you've got and see if we can make a difference. Please email us today to take advantage of this great free service. And as always, we're happy to take your questions. Feel free to email us or call us. We're happy to talk about inflation, the markets, or any other concerns that you've got, and we'll always encourage you to take us up on our offer for the free complimentary portfolio review. Thank you very much for listening to me today, and good luck.
Thank you so much, Gary, for the informative presentation. As Gary said, feel free to reach out to Wealth Management and Trust using the information on the screen, or you can always go to afma.com/wealth for more general information. And again, we have webinars every month. You can go to afma.com/webinars to review past webinars and to register for new ones. Thank you so much for joining us today, and have a great rest of your day. We look forward to our next opportunity to serve you.